want to ask you a little about the market. You've been watching it for 40 years or more. What do you think it will take to bring investors back into the stock market in a big way?
Every down market creates this environment of dull trading, and investors are hiding in the bunkers. Now, this may take longer to get restoration because of the abuse that was created out of the bubble environment of 2000, 2001, and may take us 1 or 2 years longer than it had in past down markets.
Are stocks in general cheap?
I think they're a great value right now, but I think the companies that are the best companies are the ones who have free cash flow, who are in a position to pay dividends, increasing dividends.
I want to ask you a bit about Charles Schwab Corporation as an investment. Stock's been hit hard, as all brokerage stocks have been hit hard. What's the way out for your company? Greater trading volume or something else?
Our company has moved forward, and we like to think of ourselves now as the unlimited choice brokerage firm. Full choice for everything. If you want to have a separate account managed by a U.S. trust, we have Schwab Private Client, we have formation of a new bank that we hope to be offering those kinds of services early next year, assuming our charter comes through, as we expect it will. So there's new ways of revenue for the company, but I think more than anything else, we've been winning in the marketplace. Assets have been flowing into Schwab at a very rapid rate. In fact, our share market has been very competitive with all the other brokers.
Well, you have added a lot of assets, as your advertising is saying. What's your most realistic explanation of why that's so?
Well, I hope it, based upon the premise that the company wants to be and has been a company of the highest level of ethics. And I think we can stand on that fairly firmly, and I think people like that. I don't think people like dealing with tainted material, tainted food. I don't think people like that. I think the message is getting out there, and I think we're hopeful that we'll win in the marketplace just by offering a service that people can trust.
If you're wondering which companies look best and worst by the equity ratings Charles Schwab talked about, here's a sampling. Only 10% of companies get a grade of A, and they include Clorox, Lexmark International, the maker of computer printers, Lockheed Martin, Microsoft, and United Health Group. Among those that are flunking out with D's and F's are a bunch of famous names, including Hewlett-Packard, Southwest Airlines, Target, Apple Computer, and Krispy Kreme donuts. And if you love some of these companies, or just the donuts, remember, the ratings don't mean they're bad companies, just that at today's price, they're not good investments. As for Charles Schwab, the company doesn't rate itself, but the consensus recommendation of analysts is a gentleman's C at best. Karen?
Hedge funds used to be thought of as only for the rich and super rich, but not anymore. Now those unregulated private pools of capital, free to make risky bets such as shorting stocks and complicated currency plays, are within the reach of even small investors. And while you may think your money is not involved in hedge funds, think again. Take a look at just a few of those investors. All the teachers and cops whose money is with CalPERS, the California Public Employees Retirement System, Indiana University's investment fund, and even the YMCA retirement fund. Well, Jim Hedges runs LJH Global Investments, a hedge fund advisory firm. Why take the risk of investing in a hedge fund? Well, for starters, his firm is up about 5% so far this year. Mike Vogelsang is president and chief investment officer of Boston Advisors, a top boutique that invests broadly, not limiting themselves to certain investing styles. Gentlemen, welcome. Thank you for joining us.
Thanks for having us. Hi, Karen.
Jim, let me start with you, because normally we wouldn't have a hedge fund manager on to talk to our viewers, who are mostly small investors.
Sure.
But in this environment, with regulation and volatility, why should they be considering hedge funds?
Well, I tell you, first of all, I'd like to try to dispel a notion that I think is fairly inaccurate, and that is that hedge funds are risky investment vehicles or volatile investment vehicles. The reality is that hedge funds as a group incorporate about 20 different styles of investing, not just long and short equities, but lots of different types of sectors. And those sectors have got varying levels of risk and return objectives, and therefore there's a lot of diversity in the hedge fund world. But the bottom line is that the average investor is somebody that only has a one-way ticket to the stock market without an ability to protect the downside. So most traditional investors, individual investors, have done nothing but lose a lot of money over the past year or 2 years. hedge funds with lower volatility as an asset class, meaning lower risk, have the ability to preserve wealth. And that's really why I think it makes a lot of sense for certain types of investors to get involved with hedge funds.
Well, what type of requirements would be needed for that investor to get involved in hedge funds?
Well, hedge funds still require a private placement investment structure, which is to say that they are sold not publicly, but they are sold privately. And they require that investors be accredited investors, which does require certain higher income standards or net worth standards. But what is new today are two things. One that you alluded to and something else. The fact that investors are exposed to hedge funds, whether it's through a corporate pension or 401k or other type of retirement plan, they might be exposed to them. And then additionally, we're starting to see hedge funds offered through funds of hedge fund vehicles that are offered in many cases with very low minimum investments, maybe even as low as $10,000 investments. So while the net worth requirements or the income requirements might be high, investors can still actually invest a very small amount on a relative basis.
Well, Mike, what do you think about these alternative investments?
You know, in today's marketplace, I think we have certainly seen the limits of what happens with long investing. Hedge funds are those that, you know, in a good market, there were some really great numbers back in the 90s when the financial markets around the world were going up. I think Jim's right in the sense that hedge funds are exactly that, a hedge. And they're not just for the super rich anymore. There's clearly becoming, they are becoming more mainstream as we move along here.
Well, you know, since fourth month in a row, investors have pulled just a ton of money out of stock funds and put them into bond funds. Did we jump out of the frying pan into the fire?
Well,
They just moved too late, actually?
You know, we've seen bond funds and demand for bonds just explode. And we think that it's clearly, to be gracious, late in the game for bond investors. It's very well known that investors follow the hot investment, and retail investors particularly. And people are clearly bailing out of stocks. It's part of the reason why we've had such a difficult summer, of course, as sales have been made to raise the cash. Bonds rallied, but I think right now that relative to stocks, bonds are a poor investment, and stocks actually look pretty good.
Let me ask you about the corporate governance issue. You know, we've seen these scandals and all sorts of attempts to rectify the scandals, and here we are facing another one again. Are we going to really see any change, Mike?
Well, I think we'll see change. In fact, a few of the boards I sit on in terms of the mutual fund world, the pressure is on the boards. The Sarbanes-Oxley Act, the USA Patriot Act is really clamping down on disclosures and simply making sure that the numbers are right. I think, importantly, and what I find interesting is that the effect of in the markets, I think, is just about over. The sort of sell-off with lack of confidence is over. We saw this past week 3 or 4, maybe 5 companies come out that have already been hammered pretty badly. And they announced additional charges where they simply found, Tyco was one of those, that found additional things that were wrong. And as a matter of fact, the day that happened, 4 of those stocks actually went up. And that's an important variable in the stock market today.
Jim, what about that? Do you think within this area of, like, regulation and hedge funds not being regulated, it's pretty soon sure going to be in the sights. What do you think about that?
Well, I think that whether we talk about corporate governance, CEO compensation, hedge fund regulation, we're clearly going to see a lot more regulation going forward in a lot of different aspects of the investment world. It seems to me, I would place a bet that hedge funds are going to be forced to register as registered investment advisors in the future. I think that my perception is that regulators feel that they don't have the ability to oversee what's going on in these investments, and they want to make sure that there aren't conflicts of interest and fraud and other problems that would be detrimental for investors. So I think we're going to see some increased regulation on the hedge fund side. But in terms of corporate governance, I think most of the mechanisms are actually in place. We had at LJH's Client Summit this week 2 leading corporate governance professionals, one who is the current CEO of Enron and an 11-year director of Tyco, who told us that they feel that the mechanisms are in place. It's implementing and managing those mechanisms that's critical.
All right. What types of things are you investing in right now? What type of asset classes? I know you said junk bonds were attractive.
Well, I tell you what, as we think about the universe of investment strategies in the hedge fund world, it's hard to find one that's starting to look as compelling as distressed high-yield bonds, high-yield corporate debt. If you look, for instance, at the Merrill Lynch Corporate Bond Index, 80% of that index is trading at prices that reflect distressed levels. So what we know is that the entire world is distressed in the high-yield marketplace. I think there's a lot of opportunity for turnaround and restructuring investment in that field.
Where do you see, Mike, in sort of investment opportunities?
Well, we spend a lot of our time in the stock market, so the area we have the most familiarity with. You know,
which stocks?
Well, a couple of stocks we like a lot. Particularly, these are specifically not trades. These are I think, in companies that you can establish long-term positions in.
5 years or more, 3 to 5 years?
3 to 5 years, I think, would be pretty comfortable with that, depending on what happens in the stock price, of course, and of course business. But we like Walt Disney here a lot. Disney has everything going against it. It's been on, and you know, Michael Eisner has been on the cover of many magazines questioning his management ability. You know, we've seen things that say, how do you fix Mickey Mouse? The travel industry is on its back, which of course affects the theme park business. ABC is having poor comparisons to NBC and CBS. So, you know, things are really cyclically at a bottom here for Disney, and we think the price reflects that. And as they fix the company, we think the stock's going to do real well. Another one we like a lot is Bristol Myers. Bristol Myers has the same problems. It has some management issues. It's had some problems, of course, with ImClone. But again, it's got a very nice dividend, and we think the company will either be fixed or it will be put up for sale at some point.
Jim, you have some interesting ideas about Japan and China, talking about markets that are on their backs. Tell me why.
Well, I tell you, as we have looked at the Asian markets this year, it is remarkable. First of all, I recently read a study from A.T. Kearney that said in terms of foreign direct investment, no country in the world has greater confidence for foreign direct investment than China, even surpassing the United States. So we're starting to see a new wave of capital flows into China. We also are starting to see that in Japan, there is a lot of successful investing going on a hedged format in those markets. And so we're seeing that reforms are being adopted throughout Southeast Asia as well as Japan. We're starting to see that restructuring is being successful. And I think there's a lot of opportunity there, particularly on a hedged basis.
Well, gentlemen, I got to leave it there. Jim, Mike, thanks so much for joining us. Sorry we ran out of time. Well, we talk about a lot these days, the mighty stocks that now look emaciated in this market. But now we're going to tell you about a market-defying stock that just keeps growing and growing. Weight Watchers, the longtime giant of dieting centers, was once considered downright stodgy. But since going public almost 1 year ago, this queen of svelte has become the darling of Wall Street, up almost 99%. And to prove the company's arrival into the trendy side of pop culture, it was recently featured in the ultra-stylish television program, Sex and the City.
This is psychotic. All right, it's none of my business, but don't do that. I did. I lost 24, gained 46. But the New York Times... Is the New York Times going to come to your apartment at 2 a.m. and pry the cookie dough out of your hands? I don't think so. Weight Watchers. It's the only sane way to go. You can even have dessert.
Why such oversized profits? Well, for starters, Weight Watchers is very affordable. It costs only $12 to lose a pound there, as compared with $45 at Nutrisystems and $50 for Jenny Craig. As for the future, an analyst at Merrill Lynch says the company has, quote, a large and growing target market. Jeff?
As we've been showing you, investors are searching far and wide for strategies to beat the market. One of our viewers, Terry Luther from Gainesville, Florida, may have come upon a very good one. He writes, we are starting an investment club, and I would like to find out about companies who treat their employees well. Mr. Luther is on to something. Fortune publishes an annual list of the 100 best companies to work for, and the publicly traded companies on that list, as a group, have always outperformed the market. If you had invested in the original 1998 list and reinvested in the new list each year, you would have earned 9.1% annually, which wallops the S&P's negative 2.3% annual return. Companies on the current list include Synovus Financial, which hasn't had a layoff in 114 years, Qualcomm, which just shows they don't all beat the market, Goldman Sachs, J.M. Smucker, the jam and jelly folks, and CDW Computer Centers. Last year, the CEO there said he'd shave his head if the company met its third quarter targets. It did, and he did. The next list of the 100 best companies to work for appears in the January 20th issue of Fortune. We'd love to hear from you. Write us at Wall Street Week with Fortune, Owings Mills, Maryland, 21117, or email us, wsw@pbs.org.
Well, Jeff, the events of next week could determine the course of the economy for a long time. The stakes couldn't be higher when voters go to the polls Tuesday, and the Fed needs to decide whether or not to cut interest rates again.
And after the election, we'll have an all-star roster of market players, some political insiders, and some savvy investors to sort it all out for you. That's it for now. Have a good week. We'll see you next week.
Have a great one.
Thank you for watching, and remember to like, comment, and subscribe.